will commence with next sessions in session number 1, 2, 3, topic number 1, 2, 3, we try to get an understanding about the strategic management subject. Now my job is to discuss the process we have identified. If you remember the rationale model I discussed, in there the first steps I identify was identify vision, missions, values, then goals, objectives and the targets. From there I am going to start my discussion with vision, mission and values. Vision, mission and values. So, first of all we will try to identify what is visions. In simple term we can say vision is the ultimate goal of an organization. Vision is the ultimate goal of an organization. This is the final target we are trying to achieve for the organization. This is something we are trying to achieve for long period of time. This is not a short term target, this is long term target. If you look at about the visions, this is something you focused on the future, focused on future. For example, as a student you may have a vision at the moment to become a financial proficiency, to become a financial expert in Sri Lanka. You may identify this one with time period also by year 2020 for example, to become a financial expert in Sri Lanka by year 2020. So, see I will say 2030, no, it is a long time target, no, 2030. So, you say it will take another 10 years period for you to achieve this particular goals. There are so many features associated with visions. Already I have identified few things. This is something foresee the future. We predict our future positions through this vision statement. This motivate and energize employees, motivate and energize employees, motivate and energize employees. So, when we have visions, employee know where we want to go, that will motivate them to achieve, motivate and energize employees. This is something not short term, this is not something to be achieved within short period, this is normally a long term target. This is something cannot create, this is something you have to explore and discover it, explore and discover it, explore and discover it. So, can't create it, why can't create it? For example, if someone asks me to create your visions, I can't do that because it is something you have to explore yourself and discover it. You know what are the strength and weakness of you, accordingly you have to identify this. So, for example, look at about the NSB vision statement, the most reliable and sought after choice for savings and investment solutions. So, NSB is a savings banks, so they want to ensure they are the most reliable and the best choice for savings savings and investment solutions. Right. We look at about the mission also. What is missions? We look at about the definitions given. So, mission describe the organization basic function in society in terms of the product and services it produces for its client. So, it describe what is the main function of the organization within the society in terms of the product and service produced for its clients. So, they produce different product and services for customers. From that it define their mission statement. For example, if someone asks what is the mission of CA Sri Lanka, so when they are defining their mission statement, they have to explain the product and services they give for the students. No, they may say right, enhancing accounting profession in the country. No, that may be related to that. They should have a mission statement, right. In summary form, if you look at about the missions, mission is something which deal with the present, missions. So, explain your present function in the society, right. If you look at about the visions, it is something deal with the future, no, but this is something deal with the present. So, if you look at about this in details, you may identify some relationship between those two. Mission is what is done at present, why you do something at present to achieve your future visions. Therefore, mission is the statement you have particularly deployed in the environment to achieve the vision in the future, right. If I look at about the missions, there are certain features related to the mission statement. Already I have identified one, it deal with the person, and it try to identify boundaries of the business activities, boundaries of business activities. Boundaries mean the limits. So, for example, whether you are operating in Sri Lanka or in other countries, that is one of the limit you have to identify. Mission define that. Then it define the limit on the product and services also, whether you are trying to cover all the product in the market or only few, right. For example, say the commercial bank, if you take a commercial bank, they have to identify what are the activities they are involved. Are they going to do all these banking activities, or are they going to do only restricted activities, like that. At the same time, mission try to convey answers for three questions. Who we are, what we do, where we are now. So, three questions are raised under the mission statement: who we are, what we do, where we are now. All are connect with the present. We say, for example, CA, if they try to answer this one, they can say who we are the premier accounting body in Sri Lanka. So, what we do? we try to enhance the accounting profession in the country. Where we are now, we are the number 1 accounting body in the country. Like that, they can find answers on this conveys. Then at the same time, mission is something not generic, it should be specific, not generic, specific. That means own identity should be given for an organization through the missions. If I ask a question from an organization, what is your person role in the society? If they say my person role is society to make profit, what do you think? Can we differentiate that organization from another? We can't, no. So, because it is a generic statement, therefore, you have to avoid that one. So, you have to clearly say, right, what is the business you are doing in the society through the mission statement. That is why it should be specific. So, own identity should be given to the business, right. At the same time, when you are developing mission statement, it is very important to incorporate values within the mission statements. So, oftenly when you are reading mission statement, you may come across statement like we are providing superior service, we are providing excellent service to the customers, we are providing professional service, we are working with full integrity. These are some of the values organization try to communicate within their mission statements. Right. So, now you have idea about what is mission also. Look at the NSB mission statement, providing our customers with total financial solution to optimize their savings and investment need while meeting the expectation of all our stakeholders. Now, here main job is to treat their customers, no. In addition to that one, they are trying to cover their main stakeholder group also. If you look at about Bank of Ceylon or People's Bank, Commercial Bank, so they have a similar missions. They have identified 4 main stakeholder group like shareholders, customers, employees and community. 4 main stakeholder group, and they try to communicate to the people that they are trying to cover these 4 main stakeholders expectations. So, this is little bit more broader without identifying specific stakeholder group, they say all our stakeholders, right. Then if you compare vision and missions, these two, vision and missions. So, simply we can say vision is the ultimate goal of an organization. Mission we can say describe the organization basic functions. Organization's a basic function in society, in terms of the product and services, it produces for its clients, it produce for its client, right. So, I try to identify a difference from the definition first. Then if you look at about the visions, vision normally conveys answers for where do we want to go, where do we want to go, future oriented, right. Here this conveys who we are, what we do, where we are now, where we are now, focused on future activities, or we will say future, focused on future, then mission focused on present, these are the differences, right. Then we look at about the values also. What is values? So, values are the beliefs and moral principles that underlie the organization culture. So, what are the example? Teamwork, integrity, fashion. These are some of the common example. Here we talk about the internal belief and the moral principles which are used by organization to drive them, right. Teamwork, integrity, fashions, these are very common things. So, look at the values of the NSB, look at the values of the NSB. In conducting our day to day business, we will respond promptly and act creatively with trust, mutual respect and integrity. So, you are trying to respond customer requirement very quickly and with the creativity, and they will try to maintain trust, mutual respect and the integrity. Right. Then what is the importance of missions and values for strategy formulation and implementations? What is the importance of missions and values for strategy formulation and implementations? The first one, they can sometimes be a public relation exercise rather than accurate portrayal of the firm's actual mission and values. So, these are actually some of the issues right that should be considered when you are preparing your missions and the value statement. So, hopefully what happened is this can be only for public relation exercise. So, when you enter to organization, you can see this nice mission statement and the value statement, but only for reading purpose. Practically they are not going to do this. Another consideration issue is they may be full generalization that are impossible to tie down to a specific strategic implications, full of generalizations. Sometimes they say we are providing excellent customer service, but specifically not telling how the customer service is given, only a general word. Right. Then another one is another thing you have to consider is this may be ignored by the people responsible for formulating or implementing strategy. You have a nice mission and value statement, but practically when you are preparing detailed plan for study implementation, you are not consider them. That is another issue. Then what is the role of missions and values in strategic planning process? First one is inspires and inform planning. Strategic plan should further the organization goals and be consistent with its mission and core values. So, whatever the plan you prepare should be in line with the mission and the values. You can't right deviate from that. For that purpose, you can use this. The next one is screening. Scan කරන්න පුළුවන් අපිට බලන්න පුළුවන් අපි කරපු දේ හරිද කියන එක. Screening mission act as a benchmark by which strategic plans are judged. Strategic options that are inconsistent with the company mission should not be considered. අපි තෝරගත්ත strategies implement කරන්න යන්න ඉස්සෙල්ලා strategies තෝරගනිද්දී ඇත්තටම strategies තෝරගනිද්දී අපිට මුලින්ම බලන්න පුළුවන් මේ mission එකයි value එකත් එක්ක මේ තෝරගත්ත strategy එක consistent ද නැද්ද කියන එක. තෝරගත්ත අපේ තියෙන mission එකයි value එකත් එක්ක බැලුවාම මේ තෝරගන්න තියෙන strategy එක match වෙන්නේ නැත්නම් අපි ඒක තෝරා නොගත යුතුයි. We have to reject that one, no, if that is not in line with the mission and the values of the organizations. Right. Then the process, what are the next things I have identified? Goals, objectives and the targets. So, we will look at about that also. Goals, objectives and the targets. Right. So, goals, objectives and targets. So, what is goal? Look at the definition. Goal may be described as a long-term objective aspirations. Since goal is long-term, it will probably not be fully achieved within the period of the business plan. Right. So, definition say it's a long-term objective aspirations. If I go for a very short definition regarding the goal, I can say goal is relatively long term, or I can say less specific, relatively long term performance targets, So, goal is less specific, relatively long term performance targets. Now, see this one. So, less specific, this is more generic statement, and relatively long term performance target. Compare with the objective, this is long term performance targets. That is why within this detailed definition also it say it will probably not be fully achieved within the period of the business plan. Normally we prepare business plan for 2 to 3 year period, right? We will say 3 year period, we prepare business plan for 3 year period. This may take 10 years time sometime to achieve this. Then what about the objective then? Objective, look at the definition of the objective. An objective could be described as something that the organization want to achieve within the period of the business plan. Objective can be fairly specific. Good objectives are smart, right? That is something you want to achieve within the period of the business plan. Let's say 3-year business plan, right? Within that period you want to achieve this. If I go for a very simple definition on objective, I can say objective is more specific, relatively short term performance target. Relatively short term performance target. So, 3 year business plan, 3 year business plan for 3 year period, this may take 10 years time sometime to achieve this. Then what about the objective then? Objective, look at the definition of the definition of objective. Relatively short term performance target. More specific, not like goal. Goal is more generic, but this is more specific, and when you compare with the goal, this is short term. And within this detailed definition also we identify that this is something we are able to achieve within the given time period of the business plans, right. There is a relationship between these two actually. Objectives are derived from the goals, that the relationships. Objectives are derived from the goal, derived from goals. Objectives are derived from goals. වෙන වචනෙන් කියනවා මොකද objective අපි හඳුනාගන්නේ goals මගින්. goal ළඟා කරගන්න තමයි අපි objective හඳුනා ගැනීම සිදු කරනු ලබන්නේ. Right. If I try to identify some example to illustrate this, for example, organization may have a goal, long-term goal to enhance customer satisfaction, enhance customer satisfaction, enhance customer satisfaction. To support this particular goal for 2020, you may identify some objectives also, some objectives. For example, say establish customer care center, establish customer care center, establish a customer care center in year 2020 in order to enhance customer satisfactions. Look at this example given. Here we try to establish customer care center in year 2020. For what purpose we establish this one? To enhance customer satisfactions. We set this objective to achieve the goals. Right. If I compare these two, goals and the objectives, goals and objectives. So, goals are less specific, but objectives are more specific, Then goals are relatively long term, but objectives are relatively short term. Then goals not be fully achieved within the period of the business plan. But this may be achieved, may be fully achieved within the period of the business plan, What the relationship? I identify relationship also between these two. But the relationship, objectives are derived from goals. Objectives are derived from goals. Then the relationships. Right. Then what is target? So, we will look at about target also. So, target is the measurement of an objective. Target is a measurement of an objectives. So, look at the keyword here, measurement and objective. The amount we identify with the objective, we identify as a targets. For an example, say for 2020, we set objective, earn profit. So, if you look at about this objective, here I have not identified a target within the objective. What I normally have to do is to include a target with the objective. Say earn 20 million profit in year 2020. If you look at about this objective, I have identified a amount for the profit, that 20 million, that 20 million is the target I have set. So, I am not going to explain the smart one, you know what is smart, right. Right. I am moving to the next. Purpose of objectives. There are 5 purposes of objectives. In short term, we call it as frame. So, what is the meaning of frame? Phi denote planning, then R responsibility, I integrations, M motivations, E evaluations, right. So, objective can be used for planning purpose. Actually, within the plan, actually we identify objectives, no, to achieve. For example, say with the plan we set to achieve, we will say 20% market share by year 2022. So, we set objective within the plan. Then the second one is responsibility. So, objectives are used to give responsibility to different persons and the department. Say we set sales target to 20 million for year 2020, that objective can be assigned to marketing manager. So, we give the responsibility also. The next one is the purpose of objective is integrations, consistent objectives that integrate the effort of different departments. Integrations. So, normally objective help us to integrate effort of different departments. For example, when you are setting objectives, so you have to look at about the total picture. We will say we set a sales target of 20 million rupees for year 2020, that is assigned to the marketing department. To get 20 million sales target, suppose we want to produce 10,000 unit. So, that 10,000 unit target may be given to the production people, no. Then see the integration has been taken here, right. So, objective preparing process help to integrate different effort of the organizations. The next one is motivations purpose. We use objective for motivation purpose. So, when we have set objectives, people know what they want to achieve. So, that lead for motivation of them. For example, marketing guy know his target is 20 million for the year, then right, he will be motivated to achieve that one, to get the incentives assigned for him. Then objective can be used for evaluation purpose. So, normally we set objective at the beginning of the year, then at the end of the year we can measure the actual performance, then we can compare that actual performance with the set objective. Accordingly, we can come to a conclusion whether a particular person or department has performed well or not. If I take the same example of that marketing manager, suppose at the end of the year he has taken, he has actually achieved, we will say 15 million sales. So, that indicate he has achieved only 75% of the target given, right. So, I am moving to next environmental analysis. I think it is clear for you. At the beginning also I told you how we can use this rational model for strategy formulation purpose. So, now I cover the first part, now I am moving to the environmental analysis. Under this environmental analysis, I am going to discuss about the external environment, right, external environment. So, we will look at about the content, what are the areas we have to cover here. So, environmental scanning, then PESTEL, then Porter's 5 forces, product life cycle and the BCG metrics. These are the main topic we have to cover, right. So, under the environmental scanning, so what we are trying to do is to look at about our external environment, or in other words, we are trying to look outside the organizations, right. So, here actually the main objective of carrying out the environment scanning is to identify opportunities and threats available in the external environment. So, external environment can be divided into two main areas, general business environment and the specific industry environment. The broad environment can be analyzed through PESTEL analysis, then the specific industry environment can be evaluated through the Porter's 5 forces model, right. Before moving to next one, so I will briefly explain this one little bit more for you, right. First of all, I will try to identify what is environment before moving to the external environment, right. So, what is environment? If I go for definition, I can say environment normally consists of any party, factor or force which affect or influence, influence the business activities. So, environment consists of any party, factor, force which affect or influence to business activities. So, if you look at about the source of them, it can be within the organizations or outside the organizations. If it is within the organization, we call it as internal environment within the organizations. If it is outside the organization, we call it as external environment. Right. So, in other words, any factor, party or force which can be identified within the organization, we call it as internal environment. Any party, factor or force which can be identified outside the organization, we call it as external environment. Now, here we want to analyze both our internal and external environment. As you are aware, the objective of analyzing the internal environment is to identify the strengths and weaknesses, and the objective of analyzing the external environment is to identify the opportunities and threats. Now, here I am looking about this external environment analysis. So, here what we can do is we can divide the external environment into two main parts, microenvironment and the macroenvironment. Micro and the macro environment. So, under the microenvironment, we will mainly look at about the industrial environment here. Right. So, microenvironment will be analyzed mainly through the 5 forces model. 5 forces model will be used to analyze the micro environment. Then macro environment will be analyzed through the PESTEL model. PESTEL model, right. Normally micro environment consists of the broad forces in the economy. This internal environment actually there are many things in the internal environment. Within the internal environment we can identify employees, organizational resources, other organizational resources. Then we can identify organizational structure, then organizational culture. These are the main element, right. So, these internal environment will be analyzed mainly through three tools, right. Earlier also I mentioned that one, value chain, then resources and competency analysis, then the third one is benchmarking, right. So, then comparative and industrial analysis, this try to analyze the microenvironment. There are few tools we can use for that purpose. First one is comparative analysis. So, what is comparative analysis? Here we analyze our major competitors. The objective of analyzing our major competitors is to identify what are the strength of them, what type of strategy they use, and how their activities are affecting the organization. You try to identify some of the good things of them, at the same time some of the things which is affecting to the organizations. Then another tool we can use for this comparative industrial analysis is life cycle analysis. So, in there we are trying to look at about the stage of the life of our products, so or industry as a whole, and so we try to define strategies accordingly. So, later we will look at about product life cycle. Under the product life cycle concept, we try to identify 4 main stages: introductions, growth, maturity and the decline. So, by using this life cycle analysis, we will try to identify what is the stage now we are in, and accordingly we will try to define our strategy. Then product portfolio analysis. To analyze the product portfolio, we can use the BCG matrix for that purpose. Then the next one is Porter's 5 forces model. Within this topic actually we are going to discuss Porter's 5 forces in details later, right. So, then the macro environment can be analyzed through the PESTEL analysis. So, what is PESTEL analysis? So, I am going to use PESTEL tool to analyze macro environment of the organizations. So, macro environment is the broad environment of the organization. This is the broad environment of the organizations. Within the macro environment, we can identify broad forces in the economy. Broad forces in the economy can be identified under the macro environment. The forces in the macro environment, we can identify 6 main forces that is summarized to the PESTEL model. PEST actually, PEST is the initial model, then it was expanded. PESTEL, or you want, you can change this L and E and identify. So, what is the meaning of PESTEL? P mean political environment, then E mean economical environment, S means social and cultural environment, T mean technological environment, E mean ecological environment, L mean legal environment. So, there are so many matters to be considered under each force. So, first one is political environment. So, under that we are going to look at about the present political environment in the country. So, one of the factor we can consider is the political stability. For example, whether we have a very established government, then we can look at about the policies of the present government. For example, if you are a domestic business, you can check whether the government policy is favorable to the business or not. Right. Then how about the oppositions? The matters like terrorism should be considered under this. Right. Then under economical environment, we are looking about some of the economical variables like exchange rate, inflations, interest rate, GDP growth rate, per capita income, balance of payment. So, these days you experience the impact of exchange rate, this year almost 200, no, rupee to dollar rate. So, how it is affected your business. For example, if you are selling cars, so how it is affected, the import price is going up, so that may be a unfavorable factor. When you look at about the demand for the cars may come down since prices are going up as a result of exchange depreciations. Then inflations, you know what is inflations? The high inflation is a threat for the business. Then interest rate, whether interest rate is low, if low interest rate, that is good for the business point of view, since they can obtain loan at a lower rate and invest money. Then GDP growth rate, whether it is high or low, it is high, it is always favorable, so that will increase the demand for the company products. Then per capita income in Sri Lanka, I think around $4,200, whether that is high or low. High per capita income is favorable for the business, right. Then social and cultural one, India we are looking about different races, religions, lifestyle, taste, age structure. In Sri Lanka you can find different races and religions like Sinhalese, Muslims, Tamils, religion wise Hindus, Muslim, Buddhists, Catholic. So, that should be considered by business, no. For example, Hindus do not eat some of the meats, no, right. So, you have to consider that aspects, right. Muslims Hawash, sorry, this they have a certification, no, halal certifications, right. Those are some of the considerations you have to make, right. the free then Tamils don't eat free products, no, like that, right. So then so lifestyle of the people, so people are busy these days, that can create opportunities like fast foods, right. There may be some health issues, you can look at about some of the health product like right, sugar free products, that come under this, right. You can capitalize that opportunity, right. Then age structure, you know that in Sri Lanka this nowadays elderly population is going up, that creates some opportunities for different group. For example, so product like aniline may focus on that, that's an opportunity for them, right. Then next one is technological environment, changes in information technology, right. For example, use of internet for business transactions, now these days you may experience that, right, you may be staying at home and use internet technology for business transaction purpose, right. Then automations, for example, robotic technology is used, even country like China they use robotic technology to control this COVID-19, right. Then E mean ecological or environmental. So here we look at about the ecological environment. අපි මෙතනදී අපි මේ ස්වභාවික පරිසරය ගැන තමයි වැඩිපුර උනන්දු වෙන්නේ මේ කාරණේදී. So what are the matters we have to consider? Like rising sea level, global warming, environment pollutions. These are some of the matters we have to consider. Now, rising sea level is one of the main problem the whole world is facing these days, right. Even in Sri Lanka also, no, we don't know. In some parts, I saw recently also, right. So that is affected near Goal. It's kind of like Maldives are affected. It's a global problem. So global warming, that's the biggest problem we are having, no, right. So that may kill Sri Lanka even. Right, global warming may lead for right melting this iceberg we have, right, that ultimately affect environment pollutions. The good news about the COVID-19 is the reduction of environment pollutions, no, right. So but these are temporary situations, no, after that you know that it will again there will be a huge environment pollution. So that effect to the business, government is coming up with so many regulations to curtail these environment pollutions, right. Then legal environments, under that we have looked at about different legal requirement apply for the business. For example, the tax laws, there were some changes in pay recently, right. So initially government asked not to reduce the pay, right. So now individually each person has to pay, no, right. So each one has to file taxations now, right. People they are right income exceeding 3 million for a year, right. Tax law should be considered. The labor law should be considered by the business like EPF, ETF, gratuity, right. Chopin office ordinance, Chopin office determine the leaves entitled for the employees. Now those matters should be considered by the business that come from the broad environment, right. So with that I can move to the next topic, Porter's 5 forces model. Porter's 5 forces model, right. So look at the definition of Porter's 5 forces model. A model for analyzing the strength of competition and prospect for profitability in industry. So here, so we analyze the strength of the competitions, and based on that we are going to determine the future potential for earning profit in the industry. In simple term, I can say this 5 forces model can be used to determine the industry attractiveness, determine industry attractiveness. By using this model, we can decide whether a particular industry is attractive or not. Attractiveness, how this attractiveness is determined? Attractiveness is determined based on the potential for profitability. Right. If you have more potential for earning profit, then we can say it is more attractive now. Right. This 5 forces is used for that particular purpose. This was introduced by Michael Porter. According to Porter, industry attractiveness is determined through 5 main forces. What are the 5 main forces? First one, threat of new entrants. Second one, bargaining power of suppliers. Then bargaining power of customers. Threat of substitutes. Then industry competitors. Right. So, we will look at about the model in detail. 5 forces model is very important model from the exam point of view. You can identify industry competitors, then threat of new entrants, then threat of substitutes, then bargaining power of customers, then bargaining power of suppliers, right. So, under this particular model, we have to look at about the total impact of each force. Based on that, we can determine the industry attractiveness. Sometimes one force may be favorable, but other 4 forces may be not favorable. In that scenario, if other 4 forces are more powerful, then the total impact will be unfavorable. So, we will look at the total impact of this, right. So, we will look at about each one. The first one is threat of new entrants. What is threat of new entrants? A threat of new entrants mean threat coming from potential new entrants to your industry. අනාගතයේ අපේ කර්මාන්තයට ඇතුල් වෙන්න බලාපොරොත්තු වෙන අයගෙන් එල්ලවන තර්ජනය කියන එක. Right. How it affect to the organization? If that is high, is it favorable for the business? If so many people are willing to enter to your industry, is it favorable? Not favorable, no. If they enter, they may capture our customers. Therefore, it is not a favorable factor. Normally, so threat of new entrant is high when barriers to entry is low. When barriers to entry is low, this is very high. Barriers to entry is low. So, what are the example for barriers to entry? For example, initial capital investment required. Initial capital investment required. Look at about the airline industry. What about the initial capital investment requirement? Very high, no? So, therefore, it acts as a barrier to entry. Therefore, less number of people enter to the airline industry, right. Then another one is switching cost, cost of transferring from existing product to a new one. This is related with the customer, from customers switching cost. For example, what is your switching cost of mobile connections? If you want to, suppose at the moment you have dialog, what is your switching cost to change to the Mobitel? I think these days free SIMs are given free of charge, no? Therefore, your switching cost is 0. Can you apply same for your gas cylinder? What is your switching cost of switching from LAF to some other gas, right, litro for example, right. So, can you move 0 cost? No. If you you have to pay for the cylinder, no, right. In there switching cost is high, no. So, if the switching cost is high, then the barriers to entry will be high actually, right. Therefore, less number of people will enter to the industry, right. Then the next one is bargaining power of suppliers. What is bargaining power of suppliers? Bargaining power of suppliers means the demanding power of the suppliers, whether it is high or low. If it is high, that is not favorable for the organizations. If it is low, it is favorable for the organization. For example, suppose we purchase raw material A. In that industry, only one supply is there. What about the bargaining power of the supply in this scenario? So, we purchase raw material A, only one option we have. Now in this scenario, bargaining power of the supply is very high, no? Whatever the condition posed by that person should be accepted by us. It is not a favorable scenario. Suppose the opposite scenario of that one. Suppose there are thousands of suppliers in a particular industry. In that scenario, what do you think about the individual bargaining power of each supplier? Very low, no? That is a favorable from the organizational point of view. Then the third one is bargaining power of customers, demanding power of the customers. Suppose 80% of our total sales is enjoyed by one customer. What do you think about the bargaining power of that particular customer? It is very high, no? Whatever the conditions posed by that guy should be acceptable. That is not a favorable scenario for the organizations. Suppose we have millions of customers, each one buy a small percentage from our total sales. In that scenario, bargaining power of the customer is very low, no? That is favorable for the organizations. Then threat of substitutes, Adeshika Banda Kini, threat of substitutes. What do you think about the threat coming from the substitutes products? If there are so many substitute products are available, then threat of substitute is very high. If very low number of substitutes are available, then threat coming from substitutes is very low, right. Then the next one is industry competitors. So, what about the competition among the existing players? Think about the industry where only 2 players are there. Whatever the competition, is it high or low? If only 2 players are there, what do you think about the competitions? Very low, no? Think about 100 competitor scenario. It is very high competition situations. If there are so many people, that is not favorable for the organization. For example, if you reduce the price, then what other party will do? Other party will also reduce the price. So, that will be not a favorable scenario, right. So, based on the way these 5 forces act, it will determine the industry attractiveness. If I look at about 2 different scenarios to illustrate this further. Right, here I try to identify two different scenarios. In one scenario all are low, other scenario all are high. In first scenario the competition is low, threat coming from new entrants is low, threat coming from substitutes is low, then bargaining power of the customer is also low, then the bargaining power of the supply is also low. Second scenario, opposite view. So, if you are using the 5 forces model, in what scenario industry is attractive? Scenario number 1 or 2? In scenario number 1, industry is attractive. Industry is more attractive in scenario number 1. Industry is not attractive in scenario number 2. Industry is not attractive in scenario number 2. Why you are saying like that? Look at the industry scenario number 1. Now, within your industry competition is very low. Is it favorable? Yes. Threat coming from new entrants is also low. In the future we will say there are no new entrants. Threat coming from supply is also low. That is the ideal scenario for us, no? Then bargaining power of customer is also low, and bargaining power of supply is also low. That scenario is favorable for the organization. Therefore, industry is more attractive. Second scenario, opposite of that, right? For example, the industry competition is very high. For example, if you have introduced some price reductions, so what competitors will do? They will do the same. Is it favorable for you? No, it is not good, no, right. So, second scenario is not attractive. Right. So, with that we can complete the 5 forces model. Right, what is this microenvironment? Right. So, microenvironment, the organization may investigate its microenvironment looking at those environment factors that are close to it. Microenvironment is the closest environment for you. Macro is the remote environment of you, not closer to you, right. So, in the microenvironment you can identify some of the stakeholders, party like customers, competitors, employees, shareholders, suppliers, media. Normally the 5 forces model is more attached with this microenvironment. Therefore, we use 5 forces model to analyze the microenvironment. Right. So, with that I am moving to product life cycle and BCG metrics. PLC and BCG metrics. Right. So, organizations are usually found to be only one of many competing entities in a particular industry, and it is important to be aware of the competitive pressures that an organization is exposed to. The product life cycle and BCG metrics are invaluable in this regards. So, we have to understand the competitive pressures coming from the environment. PLC and BCG concept can be used to get an understanding about that. So, first of all we will discuss about the product life cycle concepts, PLC concepts. Product life cycle concept. Like human being, product pass different stages in their life. If you look at the human beings, so birth, child, young, mature, elder, die, no? There are different stages. Similar to that, we can identify different stages in relation to a product also. Under the PLC concept, we try to identify distinct stages of the product life. So, when you are trying to identify the distinct stages of the product life, we look at about the behavior of the sales income, how sales income behave in different stages. Accordingly, we identify the different stages. For an example, so at the beginning sales is very low, then it grow, then it peak, then it decline, right. So, we look at about the relationship between time and the sales. Based on that, we identify the different stages. Normally, we can identify 4 stages in relation to the life of the product. So, what are the 4 stages we can identify? Introductions, growth, maturity and decline. So, there are 4 stages: introductions, growth, maturity and decline. I told you we identify these 4 stages in terms of the behavior of the sales income. So, at induction sales income is low, then growth sales income increase, then maturity peak, then decline, start to decline, and ultimately with the time it may die also, right. So, we look at about different features in relation to these different stages. We look at about the model, right. So, inductions, look at the inductions model, induction stage in the model. So, at the beginning, what about the sales income? Sales income is very low. Then high cost per customer. So, initially you will experience some losses. Actually, we can show some profit curve also along with this profit curve. For example, say profit curve like this, profit curve. Now, see here, introductory level you can find some losses. At the growth stage actually the loss become profit. So, maturity level the profit also peak, then decline stage initially there is a profit, but later it become losses, right. So, look at the introduction stage. So, low sales, high cost per customer, financial losses. Then if you look at about the customers who purchase the good, they can be called as innovative customers. Customers who are willing to take risks normally purchase good at this stage. And normally we can identify customer into different group, right. So, the customers who purchase good at the initial stage, then in the medium time period, then the final group, the people who are purchasing good at the last stage we call as laggards, right. Here this under introduction stage normally innovative customers purchase the goods. Whatever the competitors, number of competitors are normally very few. For a certain product there may be no competitors at all. Then what happened? Growth stage, how can you identify the growth stage? Actually growth stage the sales growth rate is very high. As a result of that high sales growth rate, you can find increase in sales. Sales is increasing rapidly. Cost per customer fall. How cost per customer fall? Now you are operating at a higher capacity level, no? When you are operating at a higher capacity level, you are going to experience some cost savings. As a result, cost per customer falls. Right? For example, bulk purchasing of raw material, that help you to get some discount. Then what happened? So now initially we experienced losses. Now at the growth stage, it become a profit, and profit increase with the time. Now customers number is increased. Now you can see more competitors. Others see the opportunity, right? They also enter into the marketplace. Then after the growth stage, you go to the mature stage. Now what about the mature stage? Will sales decline at this stage? Now if you look at the curve, see, still sales is increasing at the mature stage also. Then how do you know you have reached the mature stage? Right? When sales growth rate is coming down, we can identify now we have reached the mature stage. Sales growth rate is coming down. For example, say we will say 5-year period, we will say first year our sales growth rate is 2%, second year 5%, third year 10%, fourth year suppose it come down to 3%, fifth year it come down to 1%, right. Now that fourth year and fifth year, when you look at about that fourth year and fifth year, it is clear sales growth rate is coming down, and near future, so sales growth rate will be growth rate will be 0. So at that particular point we can identify the mature stage, the shakeout point, right. Mature stage, then what happened? Sales growth rate is coming down, but still sales is increasing, but at particular point sales peak. In other words, sales experience the highest total incomes, total sales income. Then what happened? After some time, so it come down means there are no sales growth rate, sales started to come down. Actually there are 3 phases within the maturity: increasing maturity, then the plateau, there is no sales increase, then declining maturity period, right. So what are the features of mature stage? Peak sales, that means the highest sales point. Cost per customer is lowest. How cost per customer is lowest? Now you are enjoying the highest sales income, that means number of unit you are selling is the highest level, so that help you to produce more unit, that means the capacity utilization is very high, so you are in a position to enjoy economic of scale, right. Then so profit high, maximum profit can be experienced at this stage. Mass market, stable number of competitors, is also stable. Latter part actually some of the competitors may started to leave. Then the next stage is decline, and the decline stage there is no sales growth rate at all. Actually you can experience a negative sales growth rate. As a result of negative sales growth rate, sales is coming down, right. Cost per customer is still low, right. The profit fall down. At a particular point you experience losses. Customer base contacts, usually you try to have contact with the customers. Some of the competitors leave, as a result number of competitors also reduce. I have shown the same thing again as characteristic of PLC. Similar point, so look at introduction, sales, low sales, growth, rapidly rising sales, maturity, the highest sales, then decline stage, decline, cost introduction, high cost per customer, average cost per customer, growth level, maturity, low cost per customer start to increase after particular time. Profit initially negative, introduction stage, growth stage, increase in profit. Actually what happened, negative profit become positive one. Then mature stage, high profit. Highest profit can be reached at this stage. Then decline stage, initially decline, at a particular point it become loss. Then competitors, number of competitor inductions, very few number of competitors. Then at growth stage, growing number of competitors is increase. Mature state, many number of competitors, right. Then decline stage, declining number. Customer group, the people who buy good at the initial stage we call innovators. Growth stage, the early adapters, right. Then normally if you look at about the innovation diffusion model in India, we identify this all four group. 2.5% approximately purchase good at the initial point, they are called innovators actually. Early adapters around 13.5%, right. Then maturity around 68%, right. The laggards are 16%. Then growth stage actually early adapters purchase the goods, customer group. Then mature stage, majority, that early majority and the late majority group purchase the goods. Laggards mean the people who purchase at the last. Decline stage, that the laggards purchase the goods actually, around 16% people. The number of distributors initially only few. Growth stage you connect with more people, as a result increased number. Mature stage, many distributors are there with you. Decline stage started to decline. Sales promotion initially very high. Why it is initially very high? Since product is new, right, customers do not know about the product. To give the awareness about the product, you have to spend a lot of money on sales promotion. Then growth stage high, still high. Why? Now competitors are attracted to your industry. Therefore, you have to allocate a lot of money for sales promotions. Mature state fall. Now you have to manage the sales promotion activities. Why? Now your sales is coming down, right, your profit is coming down, you are trying to manage that one, so it fall actually. At the same time actually customers are aware about your products, therefore there is no requirement to promote product again and again in a rapid way. Then decline stage, here you cut sales promotion as a survival strategy, reduce to minimal levels. So what are the problem with product life cycle concepts? Problem number one is short life cycle. With the speed of technological change, some product may have a very short life cycle. There is no time to change marketing strategies for each stage of the life cycle. So we don't have time, right. The main purpose of identify these different stages from marketing point of view is to identify different features and accordingly design the marketing program. But when you have a very short life cycle, we don't have time to apply different strategies. The recognitions, right. Theoretically I can explain this nicely, but practically can you identify the relevant stage? The practical environment may be different. For example, for a particular year sales growth rate may come down, next year again you may have high growth rates, right. It is very difficult to identify the relevant stage in practice. Not always true. Sometimes you can see some product which come to the market, but there is no growth or maturity, decline and die. You hear about product, but after some time product has already vanished. They have not experienced the growth or maturity stage. Therefore, this is not always true, right. Then changeable strategy decision can change or extend product life cycle. For example, we will say you found that sales income is coming down. Management may put lot of effort. For example, high amount of money is allocated for sales promotion of the product. So you spend lot of money on sales promotion. As a result, again customer buy your products, right. So then what happen, product may reach to decline stage and again you see a like growth stage like that. So therefore this is changeable So, with that we can complete product life cycle concepts, and we can move to the next topic, portfolio analysis and BCG metrics. Alright, portfolio and BCG metrics. So, what is portfolio? So, we will start with that. So, what is portfolio? Portfolio is a collections, right. In business environment, we can identify two type of portfolio. What are two type of portfolio maintained by organizations? One is business unit portfolio, then the other one is product portfolio. For a group of a company, we can identify both portfolio. Right. But for a single entity, we can't identify a business unit portfolio, since one business unit is there. Within that, we can identify product portfolio. Right. To analyze the portfolio, we can use the BCG metrics. BCG metrics can be used to analyze the product and the business unit portfolio. Right. So, we will discuss about the BCG metrics in details. We look at about this. Here we are going to use two variable to determine different business unit to product unit. One is market growth rate, that is one variable we use, other variable is market share. So, market growth rate can be low or high, accordingly we identify two options under that. Then market share can be low or high, then we can find 4 into 4 matrix, sorry 2 into 2 matrix, right. Market growth rate low high, market share low high. When you combine these two with 2 options, we can identify 4 options actually. Finally, 2 into 2, 4 options can be identified. Right. Then if your market growth rate is low and your market share is also low, we call them as dogs. Then if your market growth rate is low, market share is high, we call them as cash cows. Market growth rate is high and market share is also high, we call them as stars. Market growth rate is high, market share is low, we call them as question marks. Right. So, look at this one very carefully. Dogs, but dogs කියන එක පොඩ්ඩක්. So, look at dogs. Now, for example, say we have a business unit. That business unit growth rate is very low. Their market growth rate is very low. At the same time, market share is also very low. In that scenario, we call it as low dog. What do you think about that? Is it good or bad? Not favorable, no, from the business point of view. Not performing well, no. Right. Then look at this question mark also. Question mark means our market share is low, but industry is growing well. We don't know what will happen. That's why question mark is identified. If we are able to increase our market share in the future, that is favorable. By increasing the market share, we can convert them into a star, no? If that opportunity is there, that is good. But we say market growth rate also come down after some time, and in that scenario, right, it is not good to invest on the question marks, no? Stars, අපි stars කියලා කියන්නේ මොකටද? අපි කියන්නේ නේ අපිට හොඳ කාලයක් තියෙනවා අපි කියන star එක කරගෙනවා කියලානේ. So star is a good situation actually. Why is a good situation? Market growth rate is high. At the same time, our market share is also very high. That's favorable situation for us. Then the cash cow mean our market growth rate is low, market share is high. Cash cow, positive cash flows can be found with them. This is similar to the mature stage in the PLC concepts. Stars is normally similar to the growth stage. In PLC concepts, right. Now, based on this actually we can determine the appropriate strategy. Later we will look at about this. Before that, I will illustrate this one further for you, this BCG matrix. So, we use two variables, one is market share. Actually, here we use the relative market share. Relative mean comparable market share with other party, right? Relative market share. So, it can be high or low, then market growth rate, it can be high or low, right. Then here question marks, here dogs, here star, here cash cow, right. Now, if I take example to illustrate this, suppose there is an organization called XYZR company, XYZR company. They have 4 business unit, X, Y, Z and R in 4 different industries. Say X is a bank, Y is an insurance company, Z is a hotel, R is a finance company. Now they have 4 companies. Now they are trying to apply BCG metric to analyze their portfolio. Within their portfolio, there are 4 companies. Now we look at about this, say market share and the market growth rate. You say X market share is low, market growth rate is high, bank industry is growing very rapidly. Insurance company, this Y, they are in the insurance industry, market share is high, market growth rate is also high. Z, market share is low, growth rate is also low. Then R, market share is high, but growth rate is low. We look at about these 4 here in this analysis. So, how we identify X? Their market share is low, market growth rate is high. Market growth rate is high, market share is low, question mark X here. Then Y both high star. Then Z low low, we identify as dog. Then R market share is high, but market growth rate is low, cash cow. Normally these cash cows are earlier stars actually. What happened, they enjoy the sales, but what happened after some time industry growth rate is coming down, therefore they become cash cow. But cash cow normally generate cash for the business, right. I think it is clear for you, right. I will illustrate this further. Right, I have a few questions for you here. Now, my first question is, assume Y and Z's are in same size, what is best one? Y or Z's? Both are question marks, Y and Z. So, Y is better than Z's. Why I am saying like that? Look at Y. So, here Y market share is high. If you look at about this axis here, sorry, this axis, here see, here Z market share is low, but Y market share is high. At the same time, if you look at about the growth rate also, Y growth rate is higher than the Z growth rates. Only a small push you need to convert them into a star, right. If you increase market share a little bit more, right, so it will automatically become a star, right. But here the distance is too much, you have to push to here, too much distance Z has to go, therefore Y is better than the Z's. What do you think about the total portfolio here? Now, we have 4 business units. If you are asked to analyze this total portfolio, so what do you think about this? When you analyze in the total portfolio, there are 2 question marks. Two question marks. Then 1 star, then 1 dog. Right. What do you think about the stars? Can we get cash out from the star? No, star in a growth market, that is true, they are performing well, but they need more cash, no? They are not in a position to give cash. The cash generated by them may be used by themselves. These 2 question mark, they need more money. For example, Y, here organization want to put more money for Y to increase the market share and convert them into a star, right. Then the dog, they are not in a good position to create cash. If you look at about this portfolio, it is not a balanced portfolio, right. So, because there are some fundamental weakness here. Suppose we have a cash cow here, big cash cow, generate a lot of cash for the business. So, we will say T for example, right. So, this is a good scenario because we have a cash cow also, the cash generated from this can be used for X and Y, right. Right, I think it is clear for you. We look at about each one. Look at the stars. In the short term, these require capital expenditure in excess of the cash they generate. That is why I told you that you need to get cash from someone. In this, the example I given, I say that if you have a cash cow, so there will be a positive cash flow with that cash cow. That cash can be used with the stars. They are still not having the capacity to become independent. They need money, right. So, in the short term, these require capital expenditure in excess of the cash they generate in order to maintain their market position and to defend their position against competitors' attack strategy, but promise high return in the future. Cash cows, these are open product in the mature stage of the product life cycle. I told they are they are equal to the mature stage. They usually well established products with wide consumer acceptance, so sales revenue are usually high, very high, right, sales revenue. Then you need very little capital, they create more positive cash flows to the business. That can be used to, look at this last sentence, cash cows can be used to finance the stars or question mark that are in their development stage. Fund created from the cash cow can be used to finance stars and the question marks. Then question mark, look at the question mark. The question with this product is whether they justify considerable capital expenditure in the hope of increasing their market share and improve their market share, right. So, you have to take a decision whether it is worthy to invest money on this or not. For example, if you look at this Y and Z example I provided, so Y is worth Y compared with the Z. Why Y is better compared with the Z? So, from a small investment you can convert Y into a star, but Z is not easy. In relation to Z, right, if possibility to convert them into a star is very low, then you have to take a decision to get out of that, right. So, the question mark have the potential to become stars if they are successful to develop. However, if they develop is not successful, they may end up as dogs. Which dogs? These may be former cash cow that have fallen on hard time or question mark that did not succeed. This cash cow also convert into a dog, no, with the time. Or it can be a question mark that fail to increase their market share and ultimately become right dogs. They may have a useful strategic role either to complete a product range or to keep competitors out. Still you need to have them. The remaining life of dog is unlikely to be a long, very short period they have, after some time they will die. Right. So, with that we can complete chapter number 2 also.